Welcome back to Morning Trade Live. It's time to go inside out on Homebuilders. Joining me now, Rogers Healy, founder, CEO, Rogers Healy and Associates Real Estate. Thanks for being with me. We have a lot to talk about. It's good to see you. So how's the housing market right now as we're into spring, approaching summer?
No, it's crazy. Breaking news. Everyone still needs a place to live. And it's been, it's been a spring market. And this is the stuff that we've seen now for years. The difference between now and a few years ago is that the seasons are, kind of back to normal. So we're based in Dallas, which is kind of a unicorn city, no matter where you are. And the real estate market has been awesome. It's been driven by millennials and baby boomers. And we've seen this now for 3 years straight. I think we have another decade of it, but yeah, it's been consistent. We've been blessed, even with these interest rates, hanging out right around 7%.
So much of that could be regional too, right? Because, I talk to certain people and they say housing and real estate has just stalled because the high mortgage rate environment, the uncertainty that people are worried about paychecks or businesses, tariffs and high costs. There is this element of concern, no?
Sure, yeah. I think that the rule of real estate used to always be location. And I think that'll always be one of the top two or three drivers. But during COVID and really over the past 12 or 18 months, I think it's become affordability. So like you said, look, it's easier to buy a house in Dallas than it is in New York City, right? But people still need to be realistic. So we've seen this, and I think the trends that are going to continue to change are the turns. I think that we're going to see people live in a house now for 2 to 3 years versus 5 to 7, which, it gives people like me and agents at my company in DFW, that much more strength in their job. But yeah, it's been interesting. And I think home builders, obviously, we've seen the ebbs and flows of the public markets, and we've seen, how their stock has done well, it hasn't done well, but at the end of the day, they continue to control the market because they have the inventory. And with the resale market being at an all-time low, you've got to rely on the public builders. And I think we're going to see that, especially in cities like Dallas, Texas.
So I'm looking at Toll Brothers is expected to report, according to RBC, lower fiscal 25 and 26 earnings per share. The seeing weaker results from the peers, worsening spring trends, signs of softness in the high-end markets. We also saw Hovnanian saw profits that were lower and some higher costs. It doesn't sound awful, but it doesn't sound good. I mean, when you look at Toll Brothers and some of the other home builders, what are you watching?
Yeah, well, look, and obviously the T word, right? The new 4-letter T word that maybe has more than 4 letters is tariffs. And we're going to see stuff affect these numbers probably in 6 to 9 months as well, with lumber, with concrete, with everything that goes into building a house. But also, in the next few months, what if the Fed does reduce interest rates? And what if we go from 7% to 6% or to 5%? And they do it strategically in a quarter that is not normally real estate heavy? Maybe that, continues to save the day. But yeah, look, they're still making money. These companies are still making money. And I think they've offset a lot of the higher costs that they had to pay during COVID for land. And builders are in the margin game. I'm in the margin game. And if they're still making money, that's not necessarily a bad thing. It's just that the ride of these, crazy roller coasters that we saw with people moving, on a whim, I think those days are over, which frankly, I think helps stabilize the real estate market.
How about the interest, the engagement, the foot traffic, the clicks? Any way to gauge that? Because they said that spring selling season has been worsening the trend. What are you seeing?
Again, most of what we see front row is here in DFW. And DFW really has been, a unique case study in its own. And I think that we really are part of the next boom town. And it's the only city in the country that I think that you can build all 4 ways, which gives us just opportunity to expand our metroplex literally to Oklahoma during my lifetime. So, we've seen it a little bit differently. I know other people have gotten, hurt, but if you look at the top markets in the country, it's not what you think. It's the Midwest. It's pockets of Texas. It's obviously DFW. But, we've seen this stuff kind of surge. But also the clicks that we're seeing this spring versus 2 or 3 years ago, this is probably more, it's more stable. And I think that people have to grasp that and realize that millennials are 40% of the buyers across the country.
You said in your notes that D.R. Horton's scale creates stability. Toll Brothers proving luxury is resilient. Pulte balances agility and efficiency. And Lennar wins with tech and transparency. I like these headlines you provided for us. That sounds interesting. Everything's included model. What does that mean, Lennar?
It's easy, right? And I think, again, they know their buyers really, really well. People want convenience. They want lock and leave. And something that's also creeping up is people that are building to rent. And I think we're going to see this trend continue to happen where baby boomers can go and exit their home that they probably have next to no debt on, go buy something, lock and leave, which is going to make it more convenient. And obviously the world is driven now by convenience. That's the easiest way to make money in any industry. We know the term AI, it's only getting more substantial every single day. So how do these companies integrate it where it's super easy for the buyer, where the process is simple? And buying a house, no matter where you are, it's not necessarily a fun process, but it should be easy. So these companies are really grasping this and realizing that their market, really is owned by two big demographics.
There are people who love the stock market and investing, and others who prefer to invest in real estate because they feel that's the way to make money over time. What say you? I mean, what kind of investment in real estate? You said you're buying properties for rent, and that's what made me think of it. I know people who, while some were so worried about the sell-off we saw recently, others were like, oh, well, I bought a house instead, and I'm feeling pretty good about that right now. How long does it take to really make money on buying a house, turning it around? I see these shows where they flip them in a few months, but normal people can't do that. What's realistic?
I'm wearing a shirt by a company called Snaps Clothing that I'm an owner in, drinking a goat fuel, which I'm an investor in as well. And I prefer that versus investing in real estate because, again, in real estate, you have headaches being a landlord. I own a property management company. We deal with this every single day. In my opinion, in markets like Dallas and Phoenix and Tampa, all across the country, Nashville, Atlanta, the way to make money in real estate is to buy and hold. Right? Managing properties, rarely will you make real money being a landlord unless it's to scale. Home flipping, we've all seen the TV shows. I've been on the TV shows. Rarely do those things end up rosy as well. But the beauty of real estate, to be, contradicting myself, is it's a tangible investment, right? And to be able to drive by something, touch it, feel it, walk into it, and say that it's yours, that has value. But that's also why I like venture capital, is that we can help these companies grow. So the public markets have never been for me. I want to be able to have a little bit of influence and access and control over my investments, but it doesn't require much thinking, which I think is what most people need.
When do we see 4%? I know we saw 3%. I mean, does it feel like never again for mortgage rates?
I hope not. My wife and I locked into a 2.5% interest rate during COVID, but it matures in 2 years. And we're hoping that, we get interest rates back down to 4 to 5%. But look, I don't know what I don't know. I'm a glorified realtor for a living, but they've proven they don't have to reduce interest rates, right? We still see the economy is driven by the real estate market, especially residential, and we're still seeing historic all-time high performance. And I think this is at an interest rate that's 3 times what it was 3.5 years ago, which is crazy. Right? But again, supply, demand, that's the foundation of economics. We've seen this stuff for years. We've seen it since the dawn of time. But if they do reduce interest rates, what's going to happen? Are we going to have another big push off season, which is going to change the seasons forever again? And we're having the same conversation over and over. We just don't know. But I don't think they have to keep the market stable.
All right. Well, it's great to see you. I know that we cannot have you and the CEO of Celsius on at the same time.
No way.
Because you both drink your drinks throughout the program. What if you're both drinking? Nobody's going to say anything. You'll be drinking Gold Fuel. John Fieldly would be drinking his Celsius.
I got this new can. Babe Ruth.
I'll have to carry the whole conversation, please.
Look at that.
Okay. It's good to see you. Rogers Healy, founder, CEO of Rogers Healy and Associates Real Estate. Thank you. Tom White is here. Tom, you know what I'm talking about, and you're going to be talking about Toll Brothers here with an example trade. But how about a big picture market thought?
Yeah, Nicole, I think maybe some consolidation is warranted at this point. If you look at the forward-looking PE and the S&P 500, it's above 21 again, on this bounce back that we've seen. S&P still, only about 3% off its all-time highs. It's a pretty spectacular rebound that we've seen so far in the month of May. I think optimism's getting a little bit too widespread at this point. So I'd be cautious here just because of the levels and the optimism in the market. at this point.
All right, so let's get to Toll Brothers. I mean, you know, Rogers Healy sounded pretty optimistic. There was some concern from the likes of, and he was honest, right? I mean, you're seeing some weakness. RBC noted some lower numbers that they're putting out for 25 and 26. What are the example trade that you have for Toll Brothers today?
Well, I think you take a look at, you know, the slide that we've seen since late last year. There's a chart right there of Toll Brothers. It's pretty ugly, but maybe it should be at this point. Yesterday, 30-year mortgage went back above 7%. That's not a positive for these companies. They're starting to, you know, give more incentives. That's cutting into their margins at this point. You know, remember, Toll Brothers is at the high end, nearly $1 million per house sold. Is that affluent buyer still out there in force at this point? Because if you look at a lot of the housing data, it's not good by any stretch of the imagination. And then valuations on companies like Toll Brothers really low, in the single digits as far as PEs go, right? That's typically what we see, but we're at the low end of what we have seen over the last couple of years in some of these home builders. The option market's pricing in about a plus or minus 6.5% move in the shares, nearly $7 either way in this one. This is a lightly traded stock, so you've got to do some price discovery. But I looked, if you're bullish on this name, you think it's going to rebound a little bit. It's still down about 37% from those all-time highs that we saw last November, above $169 a share. So I looked at a call diagonal where if you think it's going to rebound in a really short time frame based on this earnings, this takes advantage of that. Going out to the June monthly cycle, so 31 days to expiration, by the 105 strike call. That's slightly in the money. It's got that higher delta. It reacts more like the stock. And then in the near term, May 23rd, weekly options that expire in just 3 days. We're going to sell the 112 strike call. So a bullish $7 wide call diagonal is about setting up for that one standard deviation move that the option market's pricing in. You're going to pay a debit of around $480 for that. That's going to be your risk, $480 per spread. Break even, anything above about 107 is going to be profitability on this one. But you can see here from the risk profile, the apex of profitability at or near that short strike, which lines up with the one standard deviation move that the option market's priced in. But because you're paying less than the width of this call diagonal, you only have one break even. So anything above about 107 is going to be profitability on this one, even if it jumps maybe 2 or 3 standard deviations if you get a big surprise to the upside. But that break even, about 1.5% above the current share price. So you don't need a massive gain to be profitable on this type of trade. And you're buying a lower implied volatility in that June 20th monthly options that expires in a month. You're buying about a 46% implied volatility level on aggregate in that series. In the near term May 23rd options where you're selling that 112 strike call, you're selling about 100 or about a 90% implied volatility. So that dispersion between implied volatilities lowers the price entry point and risk on this trade.
And both Toll Brothers and Lennar have a similar chart where they fall off this year. For example, Lennar, 6 months down 35%. How would you go about an example trade on this one?
Yeah, this is another name that PE valuations are really low in this name, about 7 trailing PE on this one. So valuations are low. The stock's down over 40% from those all-time highs that we saw last year in September. So it's been hit pretty hard also. So I looked at a strategy that maybe takes advantage of yield. Pays a dividend yield of about 1.8%. The stock has, as I mentioned, gotten hammered here. So I looked at a covered call strategy where for every 100 shares of stock that you buy in Lennar, you want to be a shareholder in this to collect that dividend. You can sell an out-of-the-money call to the upside against it to actually create some more yield. So I went out to that same June monthly cycle, 31 days to expiration. Every 100 shares of stock you buy, you sell one of the June 116 strike calls. You're going to collect a lot of option premium on that because you have that month in duration. You're going to pay a debit of about $107.50. That's going to be your break even also on this. So you're buying the shares at a discount because you're selling the out of the money call. You're creating yield by selling that call, and because you own the shares, you collect that dividend also. That creates yield. And as you get closer to June expiration over the next month, you're going to be able to roll or adjust that short call, creating credits. That's going to lower your break even. and that's going to increase potential profitability. But this is a kind of a wait and see, collect some yield type of strategy here in Lennar.
Okay, Tom White, great to see you. Good look there at Toll Brothers, Lennar, and more. Tom White, thank you.